Hey everyone, it's September 9th, 2015. In this week's video, we'll review the S&P 500, the spot price of crude oil, talk a little bit about the high-yield corporate debt market, and share with you a few observations I've stumbled upon over the last few days that I think will help us identify a trend, if any, and draw on possible outcomes as to what might take shape, not just for the remainder of this week and month, but into year end. So let's begin by talking about the S&P 500. Um, these trend lines are not trend lines per se, they're time rays. And the reason I've included them here is, again, to give me a broad perspective, a broader sense of what markets or the different ranges markets may trade in and out of over the next few days and weeks. Uh, a lot of people, or a lot of investors, I should say, do not focus on the bigger time frame, whether it be on weekly, monthly, or even a quarterly basis when they're trading. Even if they're a day trader and their time frames they're most concerned with, be it the 5, 10, 15, 30, whatever it may be time frame, they tend to not focus or pay as much attention to the bigger time frames. I know of traders that do focus on bigger time frames. They do analyze them each day, each and every day, or each and every week at least, to again get a broader perspective as to what price may do on a day-to-day basis. So for that reason, I more often than not look at the bigger picture, again, because it gives us a better sense of where markets stand today and where they may head in the near future. So for the S&P 500, these time rays give me a sense of where price may fluctuate in and out of over the next few weeks. So clearly, the S&P, and this is something I said, there was a high probability of it happening. All the S&P has done, despite the spike in volatility, is the S&P is essentially trading at a lower range from where it was trading. Before, the S&P was trading in a 100-point range, 90, 100-point range between 2045 and 2133. That was pretty much the range for the entire year. And today we're seeing the S&P trade in a wider range between 1835, or the current low, up to today's high of 1994. I've said that one of the possibilities of what we may see happen from here to year end was the possibility of the S&P trading in a wider range, basically where 2133 served as the high end of the range and 1835, 1840, or the current low, serving as the lower end. Unless there's a seismic change in the way people perceive what the Fed does or does not do, even though has been one of the most televised Fed announcements, at least in recent memory, um, it won't really affect what we're assessing or how we're reviewing markets today. So, going forward, this is what I'm focusing in on. 1820, or the October 2014 low, is a reactionary low in the S&P. That's point number one. It's not a higher low. The higher weekly and monthly low, which I pointed out before, was 1910 to 1920. To this day, it remains intact. That remains a price point to base future support at. Um, for the market to trade lower, the S&P will need to trade below the October 2014 low at 1820, and on the same week, preferably the same day, close below 1780, which is an important fib retracement. I mentioned, I can't recall if it was in last week's video or 2 weeks ago, but I mentioned how 1770 to 1785 are two very important fib retracement points that most market participants are focusing in on. So if you get a daily and or weekly closing below 1820 and 1780, that would confirm a move as low as 1660 to 1680 in the S&P. Failure for any of those conditions to hold means we won't see lower prices. To that end, the S&P were to break above 1994, it would trade back up to 2045. However, the S&P has to close above 2045 to reclaim the previous trading range and set up for higher prices sometime in 2016, absent any negative event, whether it be market related or economic related, not just in the U.S. but globally. That's the other possibility. And the third possibility, which is the one I'm largely depending on or basing my trades on, is this wider, almost 300 point range in the S&P between 1835 and 2133 from here until year end before there's any trend to the upside or downside established. So those are the key levels. Now, if the S&P or the longer the S&P trades above this time rate, which as of today is priced at around 1930, the higher the probability that the market will eventually recapture this previous trading range and essentially trade higher. Again, absent any negative or any exogenous event. To that end, though, if the S&P cannot resolve this lower trading range from year to year end with some positive upside momentum in price, then this time rate turns negative. In other words, you can treat it as an inflection point where if, say, from here till December, as we get closer to the end of the year, we'll be more precise. But from here until year end, if this happens again, the S&P doesn't really bust through this level of resistance and this level of resistance. Actually, any trade below it, you can use it as a bogey to at least trade it down to 1780 and assess market conditions from there. But that's something you have to keep into consideration. This time rate will act bullish only for just for a certain amount of time. It's not there to be bullish forever. So again, timing is a very important component of market structure and understanding again the market profile for what it is, and it really goes a long ways in also helping you or aiding you in when establishing a trade, whether it be a directional trade, a time by price trade, or a price by time trade, or a pairs trade, or whatever it may be, whatever strategy you may be using. These types of broad assessments are helpful. The third point I want to make is the following. Notice how, and again, this is with the use of symmetry. Notice how the previous range the S&P traded in and out of was of about 16 points. Excuse me, it was of about 18. Wow, it was about 8%, right? That was a range. If we measure the same height of the current range, right, it's similar of or close to 8%. It's actually close to 9%. But the point being that notice how the S&P is basically establishing a same range or similar range percentage-wise at the lower tier or at the lower end of its current long-term uptrend. So if that's the case, this will suggest, as long as it holds, that we haven't changed market cycle. We remain in the same market cycle. So again, that's an important point to recognize. Just because perception, fund positioning have changed doesn't mean we're in a different market cycle. We may be entering one, but as of now, it doesn't appear as though we're in a different market cycle. Again, that will all depend on what price does or does not do over the next few weeks and into year end. Everybody is focusing in on oil. Last week, I mentioned a few levels to watch for, and the USO, it's fairly straightforward. The good news for oil bulls is the fact that price hasn't shot up as much as one would expect. I noted how a sharp and swift rally in the price of crude oil in a very short period of time would most likely not signal a possible short covering rally where essentially short sellers and sellers target higher prices and use it as a way to work off oversold conditions to push prices lower. I mentioned how if this were to be, if this was a mid to long term, or even just a temporary, think about it in terms of temporary, because we don't have enough information as of yet to even entertain the idea of oil possibly setting a long-term bottom. But even if it's a temporary bottom, right, anywhere between a month to 6 months, we would have to, or oil, the commodity, would have to establish a well-defined bottom, more of a U type of bottom than a V type of bottom. Obviously, that takes time. And I know you mentioned how price would have to consolidate at the very least for another 2 to 4 weeks. In other words, into the first week of October, before there's any further price appreciation, if there is some price appreciation. So going forward, 1454, which is basically right in line with today's close is a very important point in USO. 1407 and 1454 are the two levels you want to watch for on the USO. Those will tell you what relative strength, if any, there is in the commodity. The higher price stays above 1454, the better the probability of $38, $39 on WTI being the low or serving as a temporary low. However, again, we want or the commodity will have to change from trading in a pattern of higher or lower highs and lower lows from one of higher lows and higher highs. But again, that's not something or an event anyone should expect or hope for until later in the year. I also drew this accelerated downtrend, mm, which is another good sign of measuring market strength in this commodity. The longer it tags this trend line without closing below it, again, the better the odds of price staying in this upper range. This has nothing to do with price confirming a bottom. It has nothing to do with price confirming further upside. It just means price is more likely not going to remain pegged towards the upper end of this established range before it moves any lower. So in oil, if you were to ask me, it's more of a hands-off approach. Note, it's important to note that volatility in oil futures is very high. It's I think the highest since 2008. So you are definitely are having to pay a higher price just to enter the transaction. So all else constant, excuse me, all else constant, and this doesn't just hold for oil but the broader markets. You're paying, doesn't matter if you're trying to buy calls or trying to buy puts or trying to set a spread, whatever strategy you're employing, it does not matter if you're buying or selling calls, or excuse me, if you're buying or selling buying calls or puts is what I should say. You're paying effectively, as of today's price, is close to 30% more just to enter the transaction, right? On average, just enter the transaction. It's not as if you've reduced your risk or if your payout potential has increased. You're simply paying more to form part of the transaction. This is why I mentioned from a few weeks back how market obviously this mentioned uh, quite a bit, but market work in cycles, and it's up to you to recognize which market cycle we're in and understand its structure. If you don't understand the market cycle and you do not understand the structure of that cycle and what trend or what the dominant trade is, then the best solution is to simply sit on hands, or if you have to be invested or have to have risk on, invest in an index fund, but do realize that you're subject to the day-to-day fluctuations of the broader markets, as opposed to you having some control or some degree of force as to what what to buy and sell. So that's an very important factor. Most of us would have to recognize. High volatility doesn't mean a high level of fear. It does, but there's a financial component, and someone I just mentioned. You're essentially being asked to pay more just to participate in the market. And unless you're very, very confident in your levels or understand the trend, if there is any, understand what all the other points you mentioned, it's a market where it's better keep off or have a hands-off approach until there is a identifiable and tradable trend. So in oil, again, much like the broader markets, it's trying to establish first a range, and from there we'll see if there's a trend that can be identified. I hate to be providing you with such little color, but that's what markets are at least from my perspective, that's what I'm seeing in the markets. And the markets today, is paying you to observe more than anything. It hasn't really give you again an identifiable trend to act on. It remains a day trader's market for the most part, and whenever you have a market that's a day trader's market, more often than not, you have high volatility because, again, you basically you don't eliminate, but you get rid of, at least temporarily, from a very important factor of the market, which are swing traders or position traders, traders that position themselves long and short, or short and long, whatever it may be, different vehicles, once they understand and once they recognize the trend. And since most of these commodities, equity products and whatnot, haven't established a range, a proper range or a proper trend, it's very hard to really make any prediction. It would be foolish for me of saying, this, I think this is going to happen because I have a strong conviction. Wouldn't really help the case at all, because again, it's open to subjectivity, and that's not what I'm interested in. So lastly, I've always go over my allotted time, but another proxy of risk, as you all know, is the HYG, or the iShares High Yield Corporate Debt Market. Notice how similar to 2014, we got a reactionary low and then bounced back. The only difference is that, unlike the S&P, who actually held the 2014 reactionary low, we didn't see that, or that wasn't the case with the HYG. So that's some internal weakness to the trade, to the leverage trade. Most everyone has been accustomed to, and up to this day, hopefully understands. So unless there's broader improvement in this side of the market, you have to remain cautious. Further upside doesn't mean upside cannot come. Just it's another warning sign, if you want to see it like that, of or another indicator to track. And the last point I want to make, a couple of people have asked me, and granted, I don't get many viewers or people that ask me questions, but the few that do care and ask questions, asked me a couple of days ago, how can I trade this market? If there's no trend, if I have a broader understanding or broader sense of what price levels to watch for, how do I trade the markets? One day the market is up 300, the other day it's gapping down 200. How can I survive in this type of environment? Aside from already, some of the advice already offered. One, there's two ways of trading this market. Actually, three ways of trading this market. If you're somewhat have a grasp of, an understanding of options, you can send some sort of a ratio spread or a calendar spread, where essentially, again, since this is a market where you are more likely not going to be paid to sell time in exchange for a price, then that could be an option. Obviously, you have to be very careful and see how some of these different front month option contracts are being priced, because I've seen in a lot of cases a lot of discrepancies, not just in the pricing, but in the Greeks for some of these options. So it's certainly the most viable way of trading markets, but you have to be extremely careful, because the high volatility could and will likely lead to a sharp reaction in either direction. So if you're even if you're setting a spread, you have to make sure that you're setting a wide enough spread where you're not called off on any one end and feel uncomfortable honoring that side of the trade. So that's one caveat. But like any other investment strategy, it has some risk. But that's one way. Another way is to set a pair trade via options or via common stock. A good idea I'll give you is probably going long oil stocks if you think they offer some value, and going long a more growth oriented sector, or a more favorable sector, right? Such as airlines. So essentially, that spread, that performance spread and yield between both sectors could actually yield the results. If you actually compare both, some airline stocks like American, United, Southwest, Spirit, whatever it may be, compared to some of the majors like Conoco, Exxon, whatever it may be, and say you were set a 1-to-1 ratio, right, in common, you would probably be up 1 to 2% on average for the last week or 2 weeks. These are numbers I'm sort of estimating based on what I've seen. I haven't actually gone through the data, but again, generally speaking, that's the type of performance you can get. It's not great, but 2% is better than having to experience these 2 to 3% up and down swings every day in the S&P 500 in an index. So that's another way. And the third way is paying extremes. By extremes, I'm not I'm not insinuating buying stocks that gap down 20% just because they gap down 20%. You know, one day the stock can gap down 20%, the next day it can gap down 20%, the next day it can gap down 20, 20, 20, so on and so forth, into perpetuity until it reaches $0. So every day you think you made a good buy just because the stock is down 20%, realize that it can drop 20% from there on out every day until it reaches zero. So that's just not a strategy. That's it doesn't really tell you anything. Again, we're interested in seeing what we're interested in analyzing things that have value, that have some meaning that we can actually relate to and analyze and whatnot. So that's not a viable option. So what I'm referring to is when you compare, for instance, a name such as Alibaba, which yesterday this stock, after having gapped up, it completely sold up from around $66, $67 a share down to 61 or 60. That was as wide a spread we've seen between Alibaba and the S&P 500, which is the red line over here, since the spread we got back on that god awful breakdown in August of 2014. So you could have said going into yesterday's close or even into today's open, seeing this relative strength and bought into Alibaba. So even if you're not as risk averse and bought this dip, because let's be honest, there was very little, if anything, to base this buy over here at the close yesterday, especially given how it closed. But even if you bought into this initial strength at around $63, $62.50, you could have made a buck $1.50 during the day. Again, not the best of numbers, but it's something. So these type of extremes, or there's a large standard deviation, you could also try to play that narrowing of that gap. So a good trade would have been, long Alibaba, long SPY. You could also treat it as a pair trade. Don't have to trade it just as a directional bet for these type of plays. So those are three ways you can trade markets. And then, as I said, if none of this really makes sense, or you just don't get it, or rather don't, like me, you just in most instances just rather take it easy. Unless there's a specific opportunity that presents itself, then cash is a position. I don't want to make this video too long, even though it's already pretty long. But I'll end it with this. For a very long time, I thought cash was not a position. I don't know why I saw it. Like I knew in the back of my mind it was a position, but I never treated cash as a position. It was later on until I realized, when I'm in cash, I often not or have noticed that I've committed far less mistakes because I see and treat cash as a position. Yes, it doesn't make me any money, but the most important part is it prevents me from making stupid mistakes, which I will more likely not make, just for different reasons. So that's a good way of staying staying cool, so to speak. So December should bring a clearer trend up or down. Until then, again, this is a day traders market. You have to be very observant, know your levels, be confident about them, stick to your trading plan. Understand that they're whipsawing everyone up and down. So you're not comfortable, and I can't say this enough. Don't trade it. The market will be open tomorrow, next week, next month, and next year. Just trade what you know, and other than that, this is a market that still has a lot to prove. I would say from here till the middle of next week, we're not going to do much as far as the broader markets. I'll do a weekly video next week after the Fed has convened its meeting to see what, if anything, notable changed towards the latter end of next week. So, with that said, thank you. Oh, actually, let me quickly just address this before I. Excuse me. Yeah, this chart over here, where it's essentially, it was brought to my attention when I was reading an article, and it basically shows a correlation between the price performance of the S&P 500 and federal tax receipts on a 12-month trailing basis. Notice how every time the 18% threshold is achieved on federal tax receipts, not only does a recession is afoot, or generally afoot within the next 6 months, but there's a sharper decline in the S&P 500. Is this something that you should be concerned with? Yes. Is it something that a signal to go out and short the market tomorrow? No. But it is something notable to take into consideration because it shows again the economic flaws and the structural weakness of the global economy, and how basically higher taxes are being used as a means to bridge a gap between assets and liabilities in government, and just increasing taxes has never really led anywhere, at least in post-modern history. So, but the point here is, what is this chart telling us? Does it mean recession is afoot? Given recent numbers and how they're congealed and played with over there in government, I would say the recession in the United States is not going to take shape anytime soon. But it does mean growth is going to be considerably weaker or going to remain fairly weak for some time to come, especially if federal tax receipts continue to climb over the next 6 to 12 months. As for the S&P 500, I would say yes, this is something a worrisome sign if we were operating in a standard or normal business cycle, where market forces actually dictate market pricing. And since we're not in that type of market structure today, you can't really just rely on a chart like this and say, oh, we've crossed this threshold, so more likely not, we're going to have a recession, and the result is going to be a declining S&P. Now, can the S&P decline another 5-10% for current prices? Yes, but what this alone be the reason why the market declined? No. So again, these are the type of charts you want to look out for. Make a general assessment, taking other factors in consideration, and just use them as a whole, for your own analysis. But it's something that caught my eye. It's something that I'll be honest, has me worried, and hopefully we'll see a change for the better next year, or hopefully sooner. But okay, so again, blog post will be up in a couple, maybe this week or next week. Again, I'm a bit busy, but I promise to put something out soon. Meantime, encourage everyone to subscribe. There's really a lot of information that I share with you on a week-to-week and month-to-month basis. Trades have gone okay, not great. I'm not somebody that's gonna come on here and say that I can guarantee you these type of results and do this and do that. When I make a mistake, I basically pony up to the mistake and do my very best to correct for it. I'm sure subscribers who are currently enrolled could attest to that. I just tell it as it is. I see what it is. I act on what I know. And that's the type, again, commentary and type of service you can expect. So, I'll talk to you next week. Thank you for taking time to watch the video. Be careful, and I'll talk to you next week.